Pro traders swear by the 50 EMA. You'll find it on almost every professional chart across Forex, crypto, and stocks, acting like an invisible guide that price keeps coming back to. Many traders treat it as dynamic support, a level where trends pause, reset, and continue. But here's the real question. Does price actually respect the 50 EMA in real time, or does it only look powerful when we scroll back and highlight the perfect bounces? Is it truly a reliable level that offers consistent edge, or are we just connecting dots after the move is already over? In this volume, we put the 50 EMA to the test and find out whether it earns its reputation or simply benefits from hindsight. In Volume 1, we focused on riding trends using the 9 and 21 EMA, learning how to stay in moves once momentum is established. In Volume 2, we shifted gears and attacked speed, breaking down the 5 and 13 EMA Golden Scalp to capture fast momentum bursts in high volatility sessions. But Volume 3 is different. This isn't about chasing moves or reacting quickly. It's about structure. The 50 EMA represents balance, positioning, and trend integrity. This volume is about how price behaves around a key level, how it reacts, rejects, and continues. This volume is about structure, not speed. Setting this up is intentionally simple because the power of the 50 EMA comes from clarity, not complexity. Open your chart, go to the indicator section, and add a single exponential moving average. Set the length to 50 and choose a clear, neutral color so it stands out on your chart without overpowering price or creating visual noise. You don't need multiple EMAs, oscillators, or indicators layered on top of it. In fact, adding more only distracts from what this level is meant to show. The purpose here is to keep your chart clean and readable so you can clearly observe how price interacts with this one key level. The 50 EMA has a specific role, helping you identify market structure, trend strength, and potential areas of dynamic support or resistance. When price respects it, it tells a story about control and balance in the market. One line, one job. In a bullish market, price must be clearly trading above the 50 EMA with a line angled upward, showing strength and control. Instead of chasing breakouts, you wait patiently for price to pull back toward the 50 EMA. When price taps into this area and shows rejection, such as a strong bullish candle, a clear wick rejection, or a decisive close back above the EMA, that's your entry confirmation. Your stop loss is placed below the most recent swing low formed during the pullback, and your take profit is set at the next structure high or using a fixed 1-to-2 risk-to-reward ratio. In a bearish market, the logic is flipped. Price must stay below a downward-sloping 50 EMA, pull back into it, and show bearish rejection before entering short, with the stop loss above the recent swing high and targets aligned with structure or fixed RR. The key is understanding that the 50 EMA is not an exact line to buy or sell. It's a dynamic zone that reveals whether the trend is healthy. When price respects it, continuation is likely. When it breaks and holds on the other side, structure has changed. The 50 EMA Dynamic Support strategy works best on the 15-minute and 5-minute time frames when traded during high-volume market sessions, which is why many intraday and professional short-term traders prefer it on these charts. On the 15-minute time frame, the 50 EMA acts as a strong intraday structure, filtering out much of the noise while still providing frequent, high-quality pullback opportunities. On the 5-minute time frame, the strategy becomes more aggressive and requires precision. But when volatility is present, price often respects the 50 EMA as a dynamic guide during strong session trends. While higher time frames offer stability with fewer setups, the 15-minute and 5-minute charts strike a better balance for active traders by delivering more opportunities while still allowing the 50 EMA to function as meaningful dynamic support or resistance, as long as trades are taken only in clear, trending conditions. I backtested the 50 EMA Dynamic Support strategy on the 15-minute and 5-minute time frames during high-volume market sessions, following strict and consistent rules on every trade. Entries were taken only when price was clearly trending. The 50 EMA had a strong angle, and a confirmed rejection formed at the EMA before entry. Stop losses were placed beyond the most recent swing, and take profits were set using a fixed 1:2 risk-reward model. Under these conditions, the strategy produced an overall win rate of 76%, confirming that the edge is real when discipline and structure are respected. Subscribe and stay tuned for Volume 4.